circular dated 11/12/13 which has been issued by the Commissioner. But yet we will have to see as to how far it has been, how far it will abide by the assurance that has been given by the department. We come to some implications of the Mahalakshmi judgment. Now, due to the e-era, where e-filing of returns, e-filing of audited statements has started since the year 2008, it has resulted in generating a number of statements on the basis of input tax, on the basis of which input tax credit is denied to the purchasing dealers. Now, what are those statements? List of non-filers of returns, list of short filers of returns, list of purchases from Hawala dealers and mismatched list of J1 and J2. Now, Hawala dealer. Simply the names of the Hawala dealers are stated on the website. Now, what is the authenticity and reliability of these Hawala dealers? How do you come to know? Is the unilateral affidavit filed by the selling dealer or a statement given on oath can be considered as the dealer as a Hawala dealer? And moreover, these proceedings by which the Hawala dealer statement has been taken from the Hawala dealer, all that goes at the back of the buyer. It is in separate proceedings. The buyer is not given any right for cross-examination. So that would violate the principles of natural justice. Now further, even on mismatch of an extra J1 and J2, the notices are being issued to the dealer, denying the set-off or input tax credit or refund. Now the mismatch can arise due to a number of accounting issues. Like for instance, when sales are recorded net or year-end transactions, in all these cases, he is asked to produce the proof from the selling dealer that the tax has been paid, which is very difficult for any purchaser to obtain. And that too, when there are a number of parties, it is even more difficult. I think to do away with all these things, usually the dealer wants to pay the amount. Now the issue of these notices denying input tax credit is also unjustifiable due to following reasons. That the purchaser has no statutory power to check whether the seller has filed the return or has paid the tax. There are no statutory provisions giving him that authority to obtain returns and challans from the selling dealer. Also, there are no provisions in the statute prescribing the purchaser to collect records of the selling vendor in order to claim input tax credit. And notices are issued on under section 23(5) for disallowing input tax credit without considering the refund which may be eligible as per the last return filed by the dealer. What he is asked is to pay the amount along with interest under 32 and 34, or else the assessment order would be passed with levying 100% penalty. Now this goes against the principles of fairness and good governance. After all, penalty being a quasi-criminal proceeding, penalty under section 29(3) requires so many things like issue of show cause notice, establishing mens rea, and giving a specific charge as to which ingredient of the section has been violated. But all these things are given a go by, and the assessment order is passed, levying 100% penalty. Well, there is one more thing, that even when the form 501 for refund has not been uploaded, in that case the refund is denied. One of the tribunal judgment is there in VAT of also. were given on the ground that the price of free articles was included in the price of the final product of the article sold along with it. So in such case, this retention would be applicable. Now, where articles have to be distributed by way of promotional campaign to stockists or distributors, like on the basis of offtake by the distributors, if some articles are given free. Now, whether for that retention would be applicable. Now, there is a DDQ in the case of IPCA Laboratories decided on 9th March 2012, where I think Mr. Parker only had was the applicant. Here what it was contended by the applicant was that free articles transferred to branch, there is no sale consideration in any of the states. These goods are not meant for sale even in the other state. And therefore, and although taking an analogy from 53(9)(a), that the corresponding taxable goods do not include consumables, stores, capital assets, and goods used as fuel. Why? It is due to the fact that these goods are used in manufacturing in the other state and they are not meant for sale. So, consider on that same analogy, if we see, then since these goods are also distributed free, no retention should be applicable. However, the commissioner has held in this DDQ that the provisions are very clear and unambiguous, leaving no scope for interpreting it in any other manner. And then once the claimant dealer dispatches the goods to the other state by way of stock transfer, retention becomes applicable, whether the goods are sold there or not. And those imported goods are transferred to the branch or agent, then can it be considered as stock transfer on which retention would apply? Here there are two views. One is that considering it that only the 53(9)(a), that only the goods contained in the manufactured product, the same has been prescribed in Rule 53(9)(b), where it says that for computing the retention, the stock the method prescribed is that value being of stock transfers on the basis of value of goods inclusive of excise duty as it appears in the books of accounts and the sale price of goods, and apply that ratio to the corresponding purchases for computing the retention of set-off. Of course, how far it is a scientific method, because on one angle we are looking to the sale price of goods and on the other side it is cost price of stock transfers. Whether it's a proper method. So we will have to see, even if in many cases the goods are being sent by way of stock transfer at cost or at less than MRP price or at selling price. So in all these cases the cost will have to be computed, whether on average cost basis or weighted average cost basis, but whatever may be the method, it should be consistently followed. Coming to Rule 53(6). The rule provides for reduction in set-off when sale of goods is less than 50%